So one of Warren Buffett's most famous quotes is, of course, to be fearful when others are greedy and to also be greedy when others are fearful. Well, with the stock market still surging up to a new record high this year, despite the economy being in really bad shape, it looks like Buffett is following the former of that strategy, being fearful when others are greedy. As last quarter, his company Berkshire Hathaway only made a few small pickups in the market while actually selling much more. And so in today's video, we'll be running through 2 stocks that he purchased, as well as 3 stocks that he actually sold, and they were some very large sales at that. So you're not going to want to miss that part. It's pretty interesting stuff. Now, anyway, as we always like to do with this channel, I'll give you my own opinion on each of these stocks, and I'll even rank them from best to worst, regardless of whether it was a buy or a sell. I'm still going to compare them all against each other, which should be a ton of fun. So let's not waste any more time. I can't wait to jump into this list. Hit that like button, by the way, if you enjoy these videos. Helps me out a lot. Thank you for that support. Let's go ahead and jump into it. All right, so let's start with the 2 purchases first. And this one here was actually a brand new addition that they just started buying 2 quarters ago in Chubb Limited, ticker symbol CB, which they now increased by another close to 30% in the first quarter of this year, bringing the stake up to nearly $7 billion and worth over 2% of the overall portfolio. Now, when it comes to Chubb, this is actually one of the largest insurance companies in the world with operations in over 50 countries, and it's also the largest publicly traded insurance company as well. It's also pretty well diversified across commercial and personal property, casualty, accidents, health insurance, reinsurance, and even life insurance too, all of which makes it an ideal stock for Warren Buffett, as the man has, really always been drawn to insurance companies for their relatively stable financials and strong cash flows, with Chubb being no exception, doing a record almost $50 billion in sales and $10 billion of pure net income profit just last year alone. And even their growth is pretty good too, considering their already massive size, with sales expected to rise by a mid to high single digit in each of the next 2 years. This strong performance has also allowed them to pay a pretty nice little dividend that, while I grant you is pretty small at just under a 1.4% yield, it at least has a ton of room to grow in the future with only a 16% payout ratio. Unfortunately for me though, the stock has already risen to a record high, leaving the valuation a bit higher than the sector at current levels. I also think the business is a little too boring for my personal taste. However, I do think that it's a solid option for most investors, as the business will likely never go under given the massive insurance market that is already worth many trillions of dollars and continues to rise every single year. Insurance is just something that I think will always be needed, and I also like how insurers are able to benefit from essentially interest-free loans because of the gap in time from when premiums are collected to when they need to pay out those claims, which helps them grow their cash, invest in other assets like bonds and stocks, and of course pay out some pretty attractive dividends too. So I can see why Buffett likes this one, and I'll rank it fairly high for now at number 2 until we see what other stocks we got on this list. Speaking of which, moving on to purchase number 2, we have what is probably Warren's favorite big oil stock in Occidental Petroleum, ticker symbol OXY, which they increased their position on by only a couple percent. However, it's already one of their largest holdings at over $16 billion worth. I myself have never really been a big fan of this one though, not because I have anything against them personally, but just because I think pure play renewable energy stocks offer better growth, while even other legacy oil companies offer better value too. For example, comparing the last 2 years to one of my favorite renewable energy stocks in the giant NextEra Energy, well, we can see that both companies generated around $28 billion in sales last year. However, that was growth for NextEra from around $21 billion the year before, while OXY actually declined from $37 billion during the same time. And when compared to a legacy giant like Chevron, for example, well, OXY actually trades for a PE ratio that is over 40% more expensive than the sector and over 30% more than Chevron, while Chevron also carries a much more attractive dividend of 4.2% versus OXY at just 1.4%, which is pretty crazy considering that OXY stock hasn't even gone up in the past 10 years. So, you would think with that performance, they'd have a super cheap valuation or a giant dividend, but Nope, you get neither. Buffett, on the other hand, has received tons of special stock privileges over the years for owning Oxy, and that's probably the only reason why he's stuck around with it. But for me, as an outsider, it's of little to no interest, so I'm putting it in last place at number 5. Here is where things start to really get interesting though, because we're moving over now to the biggest sales that he made, and the first one on the list was a bit of a shocker, as it's one of Buffett's all-time favorites in the mighty Apple, ticker symbol AAPL, which they actually sold a pretty large chunk of at about a 13% reduction. That's over 116 million shares that they sold, and yet it's still worth over $135 billion and over 40% of the entire portfolio, close to half of the portfolio, and as the largest holding, it's the only stock that is really anywhere close to that amount. So then why did he sell some? Well, sometimes even as long-term investors, it is perfectly normal to trim some of your largest, best-performing stocks that perhaps make up too big of a portion. I sometimes do that myself. It's pretty rare, but it does happen. And while I grant you that this was a pretty large reduction here for Buffett, you have to remember 3 key things here. Number 1, Apple is still by far the largest holding at over 40%. The next closest is Bank of America at only 12%. So in the grand scheme of things, he's obviously still very bullish on Apple. Number 2, Apple stock has been on an absolute tear throughout its entire history, and it's usually in the top 3 of the largest companies in the entire world by market cap. So Buffett has, obviously already made enormous profits on Apple stock, which is okay to cash in on sometimes, what we call locking in profits, something that everyone does on occasion. And lastly, number 3, a couple weeks ago, Buffett actually said in a shareholder meeting that he thinks tax rates are going to rise in the future because of our insane deficit and debt levels. So he is selling some stock right now at what he feels will be a lower tax burden. And again, with the market up by so much, it makes sense for him to be more fearful than otherwise greedy, which Apple is no exception to that amazing performance in the broader market too. Apple stock itself is currently up over 300% in just the past 5 years alone, leaving an expensive valuation behind on virtually any metric you look at, like a market cap of almost 3 trillion, PEs close to 30, and even a PEG north of 2.2. And Buffett usually stays away from expensive tech stocks as they're not only a bit harder for him to understand at 93 years of age, but he also prefers less volatile businesses with large cash flow. Apple, however, I would say fits that bill actually very nicely with a sticky business, billions of devices in the wild, strong recurring revenues from services, a gigantic balance sheet, and absolutely incredible financials of around 400 billion in sales and 100 billion in pure net income profit per year. However, the issue for me personally is that at these already high prices, I'd want to see a little more growth from them, which has been pretty stagnant in recent years. And I just don't think you're going to see a major pickup in iPhone sales until they release something more innovative, like perhaps folding phones or heavier integration with AI, like much of the competition is already doing. But it is still a very strong stock regardless, and I even own some of it myself. So I'm going to put them up at number 2 and push Chubb down 1 spot to fit it in. Coming in at the next sale though, we have a gigantic decrease here, almost a complete elimination of a stock, and that was in Paramount Global, ticker symbol PARA, which they decreased their holdings on by a whopping 88%, selling over 55 million shares and leaving their position down to just 0.03% of the overall portfolio. And yet, that's actually still worth over $88 million just because of how large Berkshire Hathaway is. But anyway, Paramount is of course known for being a giant media company, which most recently they've gained a lot of attention for entering the streaming wars with Paramount Plus, which is offered at a couple different price points depending on whether you accept commercials or want Showtime bundled in. I actually like the moves that Paramount has been making though, and I think that they have a lot of strong brands and IP to fuel that service as well. I mean, they're even one of the biggest movie studios in America, usually hovering at around 10% box office market share. share, which is, pretty large. And if you look through their catalog, they've got properties like BET, CBS, which also has news and sports, CMT, Nickelodeon with SpongeBob, MTV, Comedy Central with South Park. There's Pluto, which is a free streaming service with commercials, and all the other backlog of hit movies and shows like Star Trek, Sonic, Indiana Jones, Halo, Top Gun, Transformers, and more. But unfortunately for them, the box office market isn't quite what it used to be, and even the high growth available from streaming is constantly being fought over by rising and intense competition from some of the largest media companies in the world like Disney, Netflix, Warner Brothers, NBC Universal, and even Amazon and Apple. As such, while Paramount did see an initial spike in revenue during the pandemic, those sales have now been plateauing at best. And while their profits also surged in 2021, they later declined in 2022 and actually turned negative last year. Now, most analysts do think that they'll return to profitability moving forward, and long term, there is a lot of value to likely be had here, with the stock trading close to 30% cheaper than the sector on a P ratio basis. However, that's mostly because the stock has been a horrendous performer, losing almost 80% of its entire value over the past decade, and Buffett has likely seen enough to just exit the position out now altogether. As for me, I already own large positions in Amazon and Disney, so Paramount does very little to attract me for exposure to video streaming. However, I do still like it more than Oxy, so I'll put them at number 4 because of their at least large amount of brands and distribution rights especially. But finally here, we're left with the last sale that we'll be covering today, and that's going to be the computer giant HP, ticker symbol HPQ, which they decided to sell completely out of last quarter after making some other pretty big sales in the stock the 2 quarters prior, which is a little surprising to me, as HP has really always seemed like kind of the typical Warren Buffett value stock that you'd expect him to invest in long term. It's kind of a boring legacy player in computers and printers. The stock has slowly climbed over the years, only up around 100% in the past decade, which doesn't seem to bother Buffett very much. It's a pretty big value with PEs less than 10 and more than 50% cheaper than the sector, which Buffett usually loves. And they generate billions in cash flow, which Buffett also loves because it fuels a very attractive dividend that yields more than 3% with a low payout ratio, a double-digit growth rate, and a double-digit growth history. So why then are they selling? Well, my guess is that they're a little worried right now about HP just not having much future potential. I know that sounds a little crazy given that Buffett, doesn't typically care about that type of stuff as much as he just likes to invest in kind of boring value plays. But when you look at it, I mean, the PC market is flooded with competition right now from not just the typical giants like Apple and even Microsoft, but also from other OEMs like Lenovo, Asus, Acer, and more. And as such, HP's financials have been falling for years, with even this year still expected to decline before they finally see a small recovery the year after. Now, longer term, management is hoping that AI especially will help the PC market recover, which they're going all in on with new AI-focused PCs, and I do actually think that they're going to see some success with a lot of that. But for me, the noticeable lack of growth just continues to kind of keep me away. I still like it more than most of the other options on this list though, especially for the dividend and the cheap valuation. So I'm giving them the number 2 ranking and bumping up Apple to number 1 by default so that I can fit it in. But there you have it, guys. In conclusion, whenever I look at the moves by Warren Buffett, especially more so recently, I just feel like he's perhaps a little too stuck in the past, thinking that some of these legacy players can bring back their old magic, whereas instead I think him and Berkshire Hathaway would be much better served investing a little more in some perhaps more exciting companies like Google or Microsoft, Nvidia, Palantir, stuff like that, even SoFi, a financial company, but kind of a fintech. Just companies that are innovating in some way, I think would serve them a little better. Because when you avoid those and instead focus so much on just kind of heavily beaten down stocks like these, well, you end up having to sell out of some of those positions when you just can't really make too much of a profit from them. And of course, we're starting to see some of that. We saw that with like HP, for example, and Paramount too. And part of that might be because, they never really believed in those companies in the first place, but were perhaps just kind of chasing value, which I can understand, don't get me wrong, but I think as long-term investors, we're better served with a combination of both value and growth potential. So I would do things maybe a little different. Anyway, that's just my opinion. And of course, this is just a short YouTube video. We're only running through a few stocks here. If we actually looked at all of Warren Buffett's stocks, we'd see some amazingly strong performing holdings that he has. So maybe this is a little bit of a unfair analysis here that I'm doing, but regardless, I just kind of wanted to share some thoughts with you. Anyway, I hope that you enjoyed the video. Please share any of your thoughts down below. I'd love to hear them, and I will catch you in the next video. Thank you for all your support, my friends. It means a lot to me. I'll see you next time. Bye-bye.